Start.
Hi, good afternoon, Hello, good afternoon, everyone. Thanks for logging into Marcellus's next webinar on consistent compounders. Today, we are going to talk about the hot topic, I guess, which is on top of everybody's mind. Last few weeks, last few months, in fact, markets have been volatile. And more recently, the volatility has been related to crude oil price spiking up. And as a result, concerns have been expressed by some of you in your questions to us in the last few days about how does that impact the profitability and fundamentals of our portfolio companies. Some of them who are sort of consuming crude derivatives as inputs in particular. So we thought we'll use this webinar to broadly talk about three aspects. Firstly, crude oil price hike and how should our portfolio be viewed in light of that. Secondly, what the fundamentals of the portfolio companies are suggesting. And finally, we'll also talk about performance of the CCP PMS, which for longer time periods has been very satisfactory and good in both absolute as well as relative way. But for shorter time periods, as short as the last, say, 3, 4, 5 months, it's been a little bit of an underperformance. We'll touch upon the factors for that and why we are not concerned. So let me start by sharing a few slides. Right now, when it comes to input cost inflation, right, in general, high pricing power companies by definition have the ability to hike their product prices and protect market share, right? Not too many companies which dominate their industries by means of market share have higher pricing power, because many of the dominant companies actually compromise on profits in the face of input cost inflation or price wars, and thereby after compromising their profits, they retain market share. Whereas high pricing power companies, they actually retain market share whilst also sustaining profits. Consistent compounders, interestingly, go one step ahead. Consistent compounders not only are able to hike product prices and also retain market share, but they curtail the extent to which product prices are hiked as much as possible, so that operating efficiencies can support their profitability. And in process, they literally, if I were to use the term, suffocate their competition, because if competition doesn't have similar degrees of operating efficiencies, then the consistent compounders, by not hiking prices enough and hence by not giving enough sort of breathing space to their competitors, they actually gain more and more market share by benefiting from such periods of input cost inflation. So let's look at a few examples from the past, and then I'll sort of summarize it in the context of our current portfolio. So this is Asian Paints. Now, why we have picked up Asian Paints? It's the largest allocation in consistent compounders. It's the highest conviction idea that we have. And at the same time, in the last 10 days, 15 days, that's also been the stock which has seen a drawdown more than sort of 20-odd%, mainly related to concerns around crude oil price hikes, right? So this chart on the left that you see on your screen is for a time period around 14 years ago, when crude oil price doubled, right, from $60 to around $140 over a period of 15 months. The impact of that was the table on the top right. Gross margins gradually compressed over the same time period by as much as 5-6%. That obviously did lead to concerns on sort of profitability of this company and the share price implications. But when you then see what this company did, they took their own time, as I said, not hike prices overnight by a very large degree, in order to avoid any impact from price elasticity of demand, and also in order to wait for operating efficiencies to kick in. So when you look at the annualized margins, which is the table at the bottom of the right-hand side, you see the annualized margins were largely unaffected, right, over the slightly longer term. Quarterly did get affected, annualized they didn't. The same story repeated itself a couple of years later, where middle of 2010 to early 2011, crude oil price went up by some 50-60%. This was a little more gradual increase in price. The quantum was relatively lower. Gross margin compression was 3-4%. And again, when you zoom out and look at the annual run rates rather than quarterly, the impact on gross margin was actually reversed, and longer term margin sustained. Likewise for say early 2016 to middle of 2018. In particular, when you look at the July 17 to September 18 period, there again over a space of 12 odd months, crude oil price literally doubled, right, from 40-45 went up to 80. That led to again margins compressing on a quarterly basis, not on an annual basis. So the same story keeps repeating itself, and this is familiar territory in terms of impact of crude oil price hike on margins of a company such as Asian Paints. When you then look at say the last 2 decades and assess the number of times when within a 3-month period, right, a short time period as short as 3 months, Asian Paints has had more than 20% drawdown in its share price. There have been actually 8 such instances, 7 of them in the table here, and the 8th one we are living through, where more than 20% correction in the share price within a 3-month period has happened. Most of these instances have been linked to crude oil price inflation. Some of them were around demonetization, so on and so forth. Now, interestingly, regardless of where after the 20% drawdown, where the share price went, if you had invested in, let's say, Asian Paints stock at the 20% drawdown level, right? So maybe the complete drawdown would have been 25 or 28 or 30% in some cases. But if you had invested at the 20% drawdown level on the date when it touched the 20% drawdown, the next 1-year return is what you can see in the last column of this table, right? It was an average of around 40%. In effect, talking about the time it takes for margins to recover, fundamentals to get back to where they were prior to input cost inflation, and hence the share price also reflects that degree of resilience. So this is not unusual. In the last sort of 20 years, it has happened 8 times, literally almost every other year. We go through this. The moment you zoom out and sort of look at a 12-month period or an 18-month period, Asian Paints' share price doesn't reflect this volatility. This is a 3-4 month volatility typically from crude oil price inflation. Now, as a result, this is the chart which some of you might have seen in our most recent newsletter. The dotted line is crude oil price. The solid line is gross margins for Asian Paints on an annual basis. Whenever the spike up is sharp, there is a bit of compression, but then there is an increase. Interestingly, whenever there is a sharp crash in the crude oil price, the margins also go up, but then Asian Paints doesn't retain the higher margins. It actually takes price cuts and sort of maintains competitiveness by sort of bringing margins back to where they were previously, right? So that's the best definition of a company which wants to remain competitive and also has high pricing power. The last one, which is the sort of last 18 months of crude oil price rally, is something that we are living through. And if you look at the way the prices were hiked in the last couple of quarters, I think December quarter had 15% price hike by Asian Paints. The margins are coming back on track. Now, more interestingly, when you look at volume growth rates, right? Volume growth rates have not been adversely affected during these price hike periods to protect margins. In fact, volume growth rates have been have been accelerated further because, as I previously mentioned, these companies, they use the opportunity to avoid hiking prices significantly and thereby gain market share. This is a simple framework to sort of put different types of companies on a 2x2 grid of pricing power versus price hikes. And the best quadrant is companies with high pricing power and relatively low price hikes, right? Good enough to maintain margins, but not good enough to leave enough breathing space for competition. That's the best placed company that you can have on this quadrant. The next best is Q3, the third quadrant, where the pricing power might be high, but the business takes enough price hikes and leaves space for competition to also operate in a more comfortable manner. The sort of uncomfortable investments that you can have in your portfolio can be of companies with low pricing power, regardless of whether they have low price hikes or high price hikes. They either lose market share or margins or both. And these companies obviously then see genuinely an adverse impact of input cost inflation on their fundamentals, right? Which is where the cause for concern should be, not so much on the second quadrant companies with high pricing power and curtail price hikes. Now, why do these firms avoid price hikes? To an extent, I summarized, but there are three broad aspects. The first and foremost is India is a big country. There is an opportunity to play the volume game, which means that you increase your penetration by making your product more and more affordable, and thereby sort of getting the faster growth in a very long runway of growth that the economy overall offers. The second piece is market share gains because of operating efficiencies. And the third piece is that if you're not leaving enough room for comfort for competition to operate, then the ability of a price war to affect or adversely impact your fundamentals, your company's fundamentals, is significantly reduced, right? So if you are a quadrant 3 company, then you might have a great pricing power in the long run. But in the short run, you can have a competition which comes in and offers half-price product, and at least for a temporary 1 or 2 year period, can adversely affect market share of your business. But if you are a quadrant 2 company, then the ability of competition to do that gets reduced significantly, right? Competition cannot really offer a half-price product for too long because there isn't enough breathing space left on the table by the market leader, because the market leader avoided price hikes, right? So those are the sort of few benefits of being a quadrant 2 player, which is where most of our consistent compounders operate. Right now, coming to the broader fundamentals of our portfolio companies, which actually is the bigger reason why we are comfortable despite what's happening to various macro factors and various sentiment driving factors these days. We are confident because of acceleration in fundamental growth of our portfolio companies over the last 2 years. Right now, there are two very different types of acceleration here. One is when you look at the revenue growth compounding over the last 2 years. And to begin with, why are we taking 2 years? We don't want to flatter the comparison by using December 2020 as the base and comparing December 2021 on top of it, because December 2020 for some companies was still adversely affected by COVID-related logistical challenges and muted demand, right? Temporary muted demand. As a result, we are looking at a 2-year comparison, which means we're taking December 19 as a base and comparing December 21 revenue with December 19, right? So that's a 2-year annualized run rate. On that basis, the non-lenders in our portfolio, companies which are not the banks or NBFCs, their average revenue growth compounding has been around 21-22%, pretty much very consistently across the portfolio, right? This early 20s rate of compounding is higher than the rate at which revenues were compounding till a quarter ago. And that second quarter FY22 2-year CAGR was higher than the compounding till the quarters prior to that, right? So sequentially, it's accelerating. The rate of growth is accelerating, even compared to the pre-COVID period, right? So whether you look at the 5-year period that this column shows, or whether you look at the 3-year or 7-year period, prior to COVID, the revenue growth compounding was only in the mid-teens to high teens at best. It wasn't in the low 20s, whereas now it has gotten into the low 20s territory. Now, if some of you might be thinking, is this because of input cost inflation leading to price hikes and volume growth not accelerating? That's actually not true, because within this 21%, no more than 4% on average broadly is the pricing element. Rest of it is all volume growth. The volume growth of our portfolio companies, which used to be in the low teens prior to COVID, has moved into the high teens now. So there is certainly a definitive bump up in the rate of volume growth rates that these companies are delivering. What about the lenders? So at the bottom, you see relatively weaker growth rates of loan book over a 2-year period. That's also because during COVID, disbursements were slowed down significantly by the most prudent lenders as well, particularly because they wanted to sort of wait and watch before getting some clarity on the evolution of borrowers' credit profile. And in the more recent quarters, you see the acceleration now coming through. So where you can see my mouse, this is a 32% average compounding of December quarter loan book growth over September quarter loan book on an annualized basis. Right, this is reflective of the ongoing momentum in their loan book disbursements, and again, a much higher rate of growth than what it used to be prior to COVID. So there's a decent acceleration across the board. Why is this acceleration really happening? So largely it's market share gains, and this market share gain is broadly speaking due to 3 types of capital allocation decisions that have been taken by these companies over the last couple of years. Right. The first type is acquisitions, which honestly speaking haven't yet fully factored into the numbers that you see on your screen. So a Dr. Lal PathLabs acquiring Suburban, a Pidilite acquiring Araldite, and these acquisitions have helped such companies accelerate their footprint in newer areas of growth beyond their core. Right. So for Dr. Lal, the core was north and east, and Suburban helps them to accelerate their footprint. The core was adhesive X epoxy, and epoxy adhesive was a large adhesive dominated, and Pidilite was never able to. So newer areas of revenue growth, and by the way, the numbers that you see, for instance, Dr. Lal PathLabs is roughly 17% growth. That is non-COVID without Suburban in it, right? This is organic, and this is without Suburban in it. But a massive gap opening up between, say, a Dr. Lal and a Metropolis and Thyrocare. Why is that? That's practically because of second type of capital allocation initiative that these companies have taken, which is around using technology investments to deepen existing core businesses and their competitive advantages. Right? Dr. Lal PathLabs, it has invested significantly behind home sample collection infrastructure in tier 2, tier 3 cities of India. And remember, prior to COVID pandemic, the tier 2, tier 3 cities had not seen any significant adoption of home sample collection as a concept. Right? COVID forced this adoption. Interestingly, Jockey in our portfolio, it has fully automated parts of its distribution network and supply chain. It's using demand forecasting technology from Blue Yonder, which I think it onboarded 4 years ago. and it's implementing an auto replenishment system that is helping reduce inventory levels and working capital cycle for both the distributors as well as the balance sheet of Page Industries itself, right? And such initiatives, they have massively expanded the distribution reach of our portfolio companies, of the consistent compounders. Just a few numbers that I can rattle off from the top of my head. Asian Paints had 90,000 dealers pre-COVID. Today, the dealer count is close to 150,000, right? That's a massive jump up of roughly 60-65% in the dealer network of Asian Paints over the last 2 years. Page Industries had 55,000 dealer count pre-COVID. Today, it's around 90,000. Dr. Lal Path Labs is expanding its reach organically in newer geographies through partnerships with mom and pop labs, where they are going to these mom and pop labs and saying that you can retain your local doctor relationship and local footfalls, but if you tie up with us, you co-brand your lab with us, you get a longer list of tests on the menu, shorter turnaround times between sample collection and report generation, and a much better service to the customer through Dr. Lal's digital interface, right? So that's the proposition, and hence Dr. Lal is also expanding its footprint. So that's the second type of capital allocation decisions which are leading to market share gains. The third type is around capital allocation to completely transform the entire business, right? Radically disrupt the whole industry. So take, for instance, Bajaj Finance as an example. It's transitioning from being a lender previously to becoming a fintech company by cross-selling newer offerings to their existing customers in a highly profitable manner, unlike the loss-making fintech companies otherwise that are prevailing out there. Titan successfully adding wedding jewelry to Tanishq. It's adding Carrot Lane as a powerful franchise to the overall jewelry business, and it's turning around their eyewear business to a highly profitable one, right? All this has happened with Titan over the last couple of years, practically. Asian Paints is totally transitioning from being a products company previously to becoming a services company by offering value-added labor as a service and as a main way to gain market share, right? So that's practically the color of the flavor of capital allocation decisions that consistent compounders have taken in the last couple of years, which is leading to market share gains. These are all sustainable. The numbers that you see, higher revenue growth rates, they're sustainable for the next few quarters and years at least, and that's what's keeping us comfortable. Now coming to the last part of my initial presentation. So the portfolio has underperformed over the last 6 months, right? So the chart on the left is what I'm talking about. When you look at the 1 year or 2 year or 3 year performance, there's actually no concern on an absolute basis, and for longer time periods, no concern on a relative basis either, right? Particularly the moment you include the COVID drawdown of 2020, the portfolio has massively outperformed. So having said that, in the last 3 months, in the last 6 months, we haven't seen the kind of resilience that COVID drawdown saw, right? So typically, what tends to happen is if there are 5 stock market crashes, there will be those such as the 2008 crash when capital gains tax was introduced, or 2020 crash when COVID drawdown happened, when this portfolio actually is not only resilient. On a 12-month basis, it goes up when the market goes down. And then there'll be sort of 1 out of 5 crashes, like say the demonetization 5 years ago and the ongoing one, where this portfolio could sort of fall with the market or maybe a little bit more than the market over a 3 to 6 month period. Now, why is this happening? Why are we not worried? This is the attribution analysis of index on the left, Nifty 50 index. Better to show the whole index. We sort of compress the font, and on the right hand side is consistent compounders, is 14 stocks. For the index, the kind of companies that have supported the index performance, they are the sort of ONGC, Coal India, PGCL, so on and so forth. these are not the companies that we would call consistent compounders. These are not the companies that we would want to own from a long-term perspective, because we don't see them possessing the kind of pricing power that companies on the right-hand side of the screen possess, right? And hence, it's not something that we would want to even consider owning if by hand of God, let's say, we were told that these companies are going to do well over the next 6 months. It's not something that would be part of Marcellus's CCP portfolio. They're typically commodities, utilities, and in an environment like this, especially when commodity prices go up, commodities and utilities typically very similar to what happened during demonetization. This is the 4-month period from 1st of October to 31st Jan 2017. 1st October 16 to 31st Jan 2017, bulk of which was demonetization related drawdown. The Nifty 50 TRI, Nifty 50 Total Return Index, at that time was around -1.5%. And these companies all put together, on average, they sort of delivered a 9-10% negative alpha, right, over those 4 months period. Some of the current consistent compounders portfolio companies, they weren't listed at that time, hence they are not part of the chart on the right. But again, when you look at the list on the left, the companies that have supported Nifty 50's performance during those 4 months, very similar names, the same commodities and utilities, and again, the same conclusion. Even in hindsight, we don't think they would have ever been considered for inclusion in a consistent compounders portfolio, right? So that's what the last 4, 5, 6 months have been, and hence, for those of you who might be concerned about the underperformance, the commodity utility piece supporting the index doesn't last for too long. More importantly, if the underlying fundamentals of companies on the right hand side, which is consistent compounders, if the fundamentals underlying consistent compounders' businesses are compounding at, say, 20-25% pretty consistently, and actually now accelerating much beyond that on free cash flows, then there's no reason to be worried. The longer you stay, the more fundamentals driven performance it will be, which is what historically as well in the long run has been. So I'll probably stop there. I'll stop there, and Pramod, do you mind taking some questions that our clients have?
Sure. So obviously, continuing with the performance thing, a client has asked, the underperformance is also there on a 2-year time frame. How do you explain that?
Yeah, no, good question. So let me go back to that. Right. So on a 2-year time frame, look, what the 2-year time frame captures only the recovery after COVID crash, right? Now, there's a mathematical illusion in this, which is worth bearing in mind. For FY20, Marcellus's CCP delivered plus 8% return. This is 12-month ending 31st March 2020, pretty much the 12-month ending at the bottom of the COVID crisis, right? COVID crash. So for FY20, we delivered 8% positive. Over the same 12-month period in FY20, markets delivered minus 25%, right? Now, what that meant was that 100 rupees at the start of FY20 in the market for Nifty 50, it went down to 75, and 100 rupees in our portfolio went up to 108, right? Now, when FY21 happened, the 108 of Marcellus went up to, rough number, approximately 150, right? And the 75 rupees of Nifty 50 went up to around 110, 115, roughly, right? Now, when you then compute FY21's performance, for Nifty 50, the 75 going to 115 is roughly what, about 60%, 75 going to 115 is roughly 60-70%, right? Whereas 108 for Marcellus going up to 150 is only about 40%, right? So there's a massive negative performance in FY21, which is nothing but a mathematical illusion, because something that falls significantly on the recovery side, even a small recovery looks in percentage terms much bigger than the recovery of something that hadn't fallen during the crash, right? So to take the example of, let's say, a couple of stocks as comparison. So IndusInd Bank versus HDFC Bank. FY20, HDFC Bank fell from 1200 to 800. IndusInd Bank fell from 1500 to 300 or 350, something like that, right? So IndusInd Bank falls 80%, HDFC Bank falls 33%, roughly, right? FY21, the 350 of IndusInd Bank went up to around 900 or 1000, which is a roughly 200% gain. Whereas for HDFC Bank, it went up from only 800 to 1500, which is no more than 100% gain. In fact, a little less, right? So FY21, massive underperformance of HDFC Bank, but that's again just a mathematical illusion. IndusInd Bank, remember, hasn't even come back to pre-COVID levels in this calculation, and HDFC Bank has delivered a positive return over a longer term. So that's why when you look at the 2-year versus 3-year, the picture is completely different. The 3-year captures the cross cycle, 2-year captures only the recovery. If you're capturing only the recovery, things that have fallen more in percentage terms on only a single side of the recovery, they look like they've done better, but they haven't.
Thanks, Rakshit. So continuing with the performance related questions, there's one question from Dr. Prakash Bhide. He says, I'm a new customer since Feb 2021, and I was happy with my returns of about 15%. But however, over the last 1.5-2 months, the returns from inception is now turned negative. So my corpus has reduced, so I'm definitely worried. What is your advice? My friends are saying I should have taken out my profits as volatility is now the new normal, and these downturns will happen.
Okay, so look, first and foremost, the latter part of the question is a fact. If you look at the last 5 years, volatility has been phenomenally high, whether it be about drivers affecting the external environment or the stock market, right? So whether it be demonetization, then GST introduction, then the whole island FS crisis, then COVID, and now the Ukraine-Russia war, and so on and so forth, or whether it be the stock market ups and downs, right? So we had a crash in 2015 when China devalued the currency. In 2016, we had demonetization. 2017 was very bullish, but 18 was capital gains tax introduction, 19 island FS crisis, and 20 COVID, and now this, right? So volatility has been high. That's the nature of the stock market. Nothing has changed significantly in the last 12 months in particular, but it's actually during times of this volatility that these companies they outshine, right? So to give you a sense, let me just share another quick slide which you might have seen in the past. So this is hang on one second. Right. So here, this is the performance of free cash flows during the last 5 years of our portfolio companies, right? It's compounded at around 22%, despite all these volatile events. As a result, the share prices have also compounded at around 26%, despite all these market crashes, right? Now, interestingly, just like I showed on another slide, demonetization, underperformance of the consistent compounder companies is also part of this, right? So the FY16 to 21 that you see, it includes the 10% negative alpha and 11-12% negative absolute return during the 4 months of demonetization. So had you actually invested in this sort of a portfolio in middle of 2016, and had we been doing this webinar rather than on 9th of March 2022, had we been doing this webinar on 9th of March 2017, it would have been a very similar experience. More recently, the negative alpha and negative absolute returns had sort of significantly reduced the performance of the overall portfolio and made it look bad relative to the index. But because the fundamentals they delivered a very healthy rate of compounding, the share price also kept delivering. So any advice, honestly speaking, any advice back then 5 years ago of not staying invested in either the CCP type of stocks or equities in general, and volatility is rising, let's sit out and invest in gold or real estate or something else, that sort of an advice would have certainly been a wrong one. The same would be our suggestion to you. Provided you can see the underlying fundamentals of your portfolio companies being robust, it's not a matter of concern in terms of what has happened in the last 6 months to the portfolio performance or 12 months, because in the long run, fundamentals drive share prices, not external related macro events.
Thanks, Rakshit. It's also related to that in terms of volatility, given consistent compounders by definition are bound to be, or at least supposed to be, less volatile than the rest of the market. The last 6 months suggests to the contrary, where we've fallen more than the market. Is this an aberration? Is this a deviation from the typical behavior of consistent compounders?
Right. So, I mean, I'll see while I talk if I can open up another slide. So in our recent book, Diamonds in the Dust, if you've read the book, you would have seen an exhibit number 80, right? There's an exhibit 80. That exhibit shows how 12-month performance of these types of stocks, so consistent compounders equivalent stocks, has been compared to the rest of the index, right? So I'm just trying to pull up that chart while we talk. And there have been instances in the past where this has happened, right? Right. So here it is. Let me share this. Right. So if you see this, this is from Diamonds in the Dust. The x-axis is the ending period of a 12-month time frame, right? And the bars that you see, the bars, if they are hanging above the zero line, it means CCP has outperformed the Sensex. And if the bars are hanging below the zero line, it means CCP has underperformed, right? Now, when it comes to periods like this, which is sort of middle of 2005 to middle of 2007, the underperformance doesn't pinch so much because absolute returns are pretty healthy, right? Even though there is underperformance because a Larsen and Toubro became 10 times in 2 years during this period, which was there in the index, not part of a CCP portfolio. There was underperformance, but the CCP portfolio's absolute performance was pretty healthy, right? And similar sort of a thing happened here, right? Where absolute return was healthy, but in a completely euphoric period after demonetization, there was underperformance, right? But the worry that is being expressed in the question, rightfully so, is negative absolute return and negative relative return. It's not happening for the first time. It happened here for a short period of time way back in 2002. It happened during demonetization, which I showed you here actually. The x-axis is the starting period of the 12 months time frame. You can see the dotted line is below the zero line, and the bars are also hanging down. So during demonetization, as I showed you in another slide, there was a good 10% negative performance in an absolute way, and that whole 12% was also negative alpha for this sort of a portfolio. So it happens a lot less frequently than the COVID type of resilience, but yeah, we've been here. This does happen. It doesn't last for too long, and hence not to worry.
Fair enough. I think that's related to another question by another client who says, they look, appreciate the fundamentals argument. You make total sense. But ultimately, we all need performance. We will all need our wealth to grow. What am I missing?
Yeah, I mean, the only thing that you're missing is that over 3 to 6 month period, share prices and stock markets are driven by factors beyond fundamentals. And we're looking at a 3-6 month period, which is why there's a sort of a negative, absolute, negative, relative. But you don't have to, I mean, going by historical data, you don't have to wait for even longer than 12-18 months when fundamentals start driving the share prices on an absolute basis. On a relative basis as well, as long as the fundamentals drive the share prices of CCPs in the sort of 20% there or thereabouts a higher run rate, the broader stock market is not going to compound at the similar pace, because the underlying fundamentals of the broader stock market don't compound at around 20% or higher, and hence the relative as well as absolute returns from a longer time frame get fixed.
Thank you. So the bunch of questions around crude and its impact on the paints, twins, and Pidilite. So one is around the extent of crude oil increase. Have you seen this sort of, barely 2 years ago, it had fallen to negative territory, and suddenly it's at 125. It doesn't look like stopping unless you have a view on the war situation. What if it goes to 150? Will Asian Paints pricing power continue to hold? A corollary of that question is also the situation this time could be different, given the competitive intensity might be different, given the slew of new entrants that have come in. And the second corollary is, look, if it's that obvious that every time crude goes up, these stocks get hammered, why don't we take proactive position by reducing exposure to such companies?
Right. So look, first of all, let me answer the last question first, which is the shortest answer. It would have been very difficult to say in the month of December 2021 that 2 months out, 3 months out, crude will be at $125, $130, right? Nobody knew what Russia-Ukraine would do. In hindsight, you can always say that, right? That it was obvious. We know how these governments or how these presidents have behaved in the past. There was enough evidence. Now, it's futile trying to sort of build logic on commodity prices and then link it to the share prices, because more often than not, actually the linkages don't work. So think of it like this: in the month of March, April 2020, it was quite obvious that lockdowns have started, and painters, contractors, carpenters are not going to be allowed inside residential societies of the top 20 cities of this country. And the top 20 cities is residential societies. They contribute to around 60 to 70% of the revenue of Asian Paints, around 50% revenue of Pidilite, right? And hence, how should somebody be expecting fundamentals to hold up? But they did. In fact, Asian Paints has seen an acceleration, right? So the kind of fundamentals that I talked about, this revenue growth of Asian Paints Pidilite has happened exactly when contractors were not allowed into the residential societies of India. This is all market share gain. The industry did get adversely affected, so the logic does work on the industry in general. The logic doesn't work on high quality companies, because the high quality companies they benefit from such adverse aspects of the economy. Which is very similar to what we've seen in relation to crude oil price historically, right? So these charts that I've shown you, practically speaking, when you look at, say, March 2016 to September 18, right, crude has more than doubled. And logic would then have again suggested that let's stay away. But look at how short a time window you get to make these calls, which need a hand of God on your head to begin with. But more importantly, the moment you wait out instead of a 3-month to 12-month period, the performance is significantly stronger. Market share gains accelerate, volume growth accelerates, and more often than not, if you try to time things, you will be left waiting on cash rather than sort of getting the upside of these events. Surprise, surprise, in the COVID crash, in fact, when the second wave of lockdown started, there was not even the kind of crash that the first wave of lockdowns saw, right? So the number of days when the whole country was in lockdown during April, May was no different from the number of days when the whole country was in lockdown. April, May 2021 was no different from the number of days of lockdown of March, April 2020, right? But the share price movements were completely in opposite directions of the broader market, of our portfolio companies, so on and so forth. And any logical rationale which connects what's happening in the newspapers to what's happening in your portfolio, that logical rationale, it fails in making the connection work, right? So that's not how investing is done in the longer run. That's how trading speculation is done, and traders and speculators very rarely compound wealth sustainably over longer periods of time. The buy and hold into consistent compounders is a totally different approach towards the kind of low risk of timing and still higher rate of return, right? So that's what I would maybe say as answer to the last question. To the first two questions, yes, we've been here. We've been to these levels of crude in the past. Can Asian Paints pass it on? So think of it like this: today in a paint project, paint material cost is only about 25 to 30%. You pay largely for labor. If Asian Paints hikes its product prices by let's say 20%, which actually it did, it hiked prices by 15% in the December quarter. The December quarter still saw around 23-25% volume growth, right, year on year for Asian Paints, despite hiking product prices by 15% in December 2021 quarter for Asian Paints, right? If you are paying, let's say, 1 lakh rupees to get your house painted, out of that only 25,000 rupees will be for paint, 75,000 rupees will be for labor. On that 25,000, if you are going to have to pay another 2, 3, 4,000 rupees, and the paint project cost instead of 1 lakh becomes 1,04,000. Interestingly, this is a paint project which you are getting done once in 5 years or once in 7 years, or maybe a little longer on average. And once in 5 years, if you see a 5% increase just before you wanted to get your house painted, I don't think it's going to have an impact, right? So that's one piece. Likewise for a Pidilite, right? The cost of Fevicol in a let's say table or a wardrobe is less than 5% of the cost of the wardrobe or cost of the table, right? If that 5% goes up by a 10, 15, 20%, the price elasticity of demand is not significant, right? More importantly, it's renovation, something that you don't do every month, every week, right? And hence infrequent demand. So those are some aspects which inherently make it a very less price elastic, low price elasticity. But more importantly, these companies, they enjoy during inflationary times by curtailing the price hikes, which their competitions cannot manage as easily as these firms can, right? So it becomes an opportunity at the end of the day on a micro basis. On a macro basis for the industry as a whole, they might still be a not such a big benefit, but market share gains are a big benefit which offset this.
Fair enough. There's perhaps one other overall investment philosophy type question before the stock specific questions. Why are you so obsessed about FCF growth being higher than revenue growth, or why are you happy with that case? Isn't that, or couldn't that be a situation where the company stopped investing, and that's why it's throwing off a lot of free cash flow, which means sooner or later, its top line growth will not materialize or will not result into higher free cash flow growth either?
Right. No, that's a very good question, and you are perfectly right. If a company has, let's say, rate of reinvestment of around 50%, and that rate of reinvestment goes down to, let's say, 10% or zero over a space of 3 or 5 years, then the reduction in the rate of reinvestment will automatically cause an increase in free cash flow growth, right? That is not a sustainable way to grow your free cash flows. And hence, as you're rightly inherently asking in the question, how are we convinced that the rate of free cash flow growth will be sustained? So point number one, when you look at this table, the last column, the reinvestment rate remains at around 50% for our portfolio companies, right? 5 years ago as well, it was at 50. 10 years ago as well, it was 50. And also there is a little bit of lumpiness somewhere. I mean, some people have in the past in our previous webinars asked us about, let's say, a 12% or a 10% for a Page Industries Nestle. Aren't they low? These are low numbers because the business models go through a little bit of evolution. The capex tends to be lumpy, especially for somebody like, say, a Nestle. Capex happens once in 4 or 5 years in a very lumpy manner, and hence when you look at the last column, at times there's an aberration. But the average is unchanged no matter which time frame you look at. It's around 50%. So the free cash flow compounding that you see from these companies, it's not because of reinvestment rates being reduced, right? Secondly, there's another way to assess that. So you can see the free cash flow compounding in sequential 5-year time periods, right? In the table on the left, 1 to 6, 6 to 11, 11 to 16, 16 to 21. If this free cash flow compounding was happening because of drop in reinvestment rates, it won't have sustained beyond, say, 3 to 5 years, right? It's very difficult to sustain over 20 years free cash flow compounding because of drop in reinvestment rates. Mathematically speaking, it's not possible, right? So that's there, and hence when you look at the gap between earnings and free cash flows, which I'll just put up here. So the gap between earnings and free cash flow for every time period in the last 2 decades, right? And there are 3 different time periods taken here, has been around a 10-12% gap, right? The table on the left versus table on the right. And this gap has been largely because of consistently reducing working capital and increasing asset turns, whether it be for Asian Paints or for Titan or for a Page Industries, so on and so forth. The next concern can be, to what extent can the inventory days be reduced for, let's say, a Page Industries, right? To what extent can the asset turns be increased for a Page Industries? So the answer to that is that from currently, say, 85, 90 inventory days that Page has, you don't need to go to 10 or 20 inventory days in order to get a 3-4% CAGR addition to the free cash flow compounding. Even a 85-90 going down to, say, 70-75 over the next 5 or 7 years is good enough to sustain the wide gap between sales growth and FCF, or even profits and FCF, right? On asset turns, think of it like this: over the last decade or so, there's been a mid-single-digit percentage CAGR for Page Industries on a metric of volume of innerwear produced per unit labor employed, right? So the entire labor workforce is employed by Page. Largely, the capex is correlated with the amount of labor workforce, because you have to put sewing machines and you have to make space for the labor to operate in it. The volume of innerwear produced, volume of apparel produced by Jockey as a ratio of the volume of apparel produced to labor employed, right, has actually increased very consistently on mid-single digit CAGRs. This is productivity gain. Is there incremental gain in productivity possible? First of all, say a firm like Asian Paints, which is far more matured than Page Industries, far larger than Page Industries, far more evolved in its journey as a business than Page Industries. A firm like Asian Paints, after becoming a 50% plus market share, after having had a 70 years of dominance in the industry, over the last 10-15 years has continued to increase asset turns by around 4% CAGR. In the last couple of years, Jockey has been investing in manufacturing capacities where the storage of raw material, finished goods, and few other parts of the manufacturing and storage process is a lot more machine oriented, is a lot more robotics oriented, which has led to further increase in productivity gains. Right? Asian Paints continues to be the sort of biggest partner of the large tech companies globally. When you read their blogs, they talk about how Asian Paints has improved its processes of manufacturing, reduced cycle times in its manufacturing process by 7%, by 10%, by using a certain technology, so on and so forth. So the degree to which this gap between earnings growth and free cash flow growth can be sustained over the next 10 years is quite sustainable. There's a very long runway before we talk about saturation. So I hope that answers the question. And hence, when you look at, say, PE multiples, when you look at various other concepts where the understanding of an investor would stop at earnings, right? That's where it's not a complete journey to understand fundamentals. If free cash flows are compounding at a much faster pace than earnings, that doesn't happen for all industries, all companies. It happens only for a select few which are more tech oriented. That is the list in front of you on the screen.
Thanks, Akshit. So here's a practical question. A client is convinced that they want to top up. If we top up, how do you go about allocating the funds? And that's related to a broader question of how do you intend to take benefit of the sort of stock price falls that we've seen, i.e. some of the portfolio stocks have fallen more than the others. Isn't there an opportunity? And again, as an extension of that, there might be stocks which you would have wanted to buy, but they were expensive. Now, have they come into your radar that you will bring them into the portfolio?
Right. No, very relevant questions, all of them. So rebalancing, which is the second question that you're in a way asking, rebalancing of the portfolio as an opportunity to benefit from is something that we do. We've written newsletters on this. We did it in the COVID crash, and as we speak, we are doing it. So many of you on this call towards the end of this month will see what benefits that we are deriving out of this. So the weights that we want to maintain in the portfolio for our clients at any point of time are defined by the conviction levels on fundamentals and the sustainability of greatness, the longevity of greatness that we see in those companies relative to each other, right? So if let's say this much is the gap, if there's a narrow gap between our conviction levels of two stocks, and then one stock goes up, the other goes down in a market dislocation, then provided the gap in our fundamental understanding of the fundamentals, the gap in our understanding of the fundamental quality of the two businesses hasn't opened up, but the share prices have suddenly reflected an opening up of the gap, then that's an opportunity to shave off something that has not fallen as much as the rest of the portfolio, or actually has gone up versus the rest of the portfolio, and buy more of something that has fallen a lot. So we do that. We've done it in the last few weeks. We are still doing it, and we keep doing it as and when these opportunities emerge. And they add massively to the portfolio values, right? Why? Because if you've done your research deep enough, thorough enough, right, which is the benefit of being a consistent compounders investor the way we do it. if you've done your research thorough enough, the market will always give you such opportunities. Non-fundamental factors will create dislocations that if you rebalance your portfolio, those dislocations will be your benefit. So something that I can quantify at this stage is what we did 2 years ago. I can't quantify what we are doing right now. We'll do it after a month or two. In hindsight, we'll show you what we did. But 2 years ago, we bought around 6% of Bajaj Finance by shaving off 1 or 2% each from Asian Paints, Pidilite, Nestle, Abbott, etc. Because during the period of March, April 2020, Bajaj Finance had fallen by 65%. Rest of our portfolio hadn't fallen much, and hence there was a dislocation opportunity to benefit from. In response to the question, what would we do if a client does a top up? If you are an existing client, we'll use your top up to rebalance the portfolio rather than sort of the shave off and opportunity based rebalancing that I was explaining in the last 2 minutes. So we'll use your top up to rebalance. If you are a new client opening your account now, we'll buy stocks in a portfolio basis are relative gradient of conviction levels on fundamentals, which automatically will benefit you via the dislocation that has already emerged through the share price movements of the last couple of months. Right. So that's what we do if you top up. And I think the last question was, if valuations become cheap, do we buy stocks which otherwise we would have avoided? So honestly speaking, we're buying companies which offer greatness, a conviction on greatness and its sustainability. Greatness is sustainability over the next several years, at some time decades. For such companies, honestly speaking, valuations before a 20-30% or 10-20% movement, before a 20-30% correction in the share price, valuations wouldn't have been expensive. If something was very expensive, then just because it has fallen by 20%, we won't buy it, because that's a very, very thin margin to play for, right? And you can't be 100% right on the precise fair value of a company. You can be broadly correct. You can't be exactly correct, and hence it's not something that you should play to the T, as in 15% or 20% crash means I get in and I exit after a 15-20% rally. We were buying companies which were deeply discounted versus their intrinsic value previously, and we are continuing to buying companies which are deeply discounted today versus their intrinsic value. Right. So not too much changes, but yeah, once in a while, if something like that does happen, we will certainly consider.
Thank you. There's of course a few questions on stock specifics. One is the exit in the portfolio. We've exited Abbott. What's the rationale for the same? And related to that is typically we keep our churn very low. In this recent months, we've seen Abbott as the second exit after Relaxo. How do we see that? Right. So in our recent newsletter, we elaborated. I'll summarize it here why we exited from Abbott. We realized in the last 6 months that there are data points that we are receiving which are concerning on 3 fronts. First and foremost, on a product such as Dufaston, where Abbott had 100% market share till a couple of years ago, a local competitor, local pharma company, has suddenly taken a massive market share away, and we've not been too comfortable with the kind of response that Abbott has had during this period of price war. There was a price war that the new entrant put in, and Abbott's response was something that was not something we were particularly comfortable with. Secondly, we saw a few departures overlapping with this sort of a time period of sort of market share loss in one large product, one or two large products actually, and those departures were not just to other parts of Abbott globally, which was a small concern relatively, because people who left India to go to other places in Abbott, they had not yet worked for too many years in India.
So the rotation shouldn't be so frequent. But more importantly, there was a long list of departures that happened at the CXO layer to competing pharma companies, right? And that was a little bit worrying. And finally, we sort of couldn't see a very healthy pipeline of new product launches in the listed entity, while some of the product launches have continued to happen in the unlisted entity and for Abbott, and hence we decided to reduce some parts of our research framework scoring on Abbott, which called for an exit from the portfolio. And ICICI Lombard was the next one, where we already had conviction. It was already part of many of Marcellus's other portfolios, and in CCP, it was the next best stock that we would have added if something had exited, which is what we did. So that's on Abbott. In terms of churn in general, yes, in the last 1 year, we've had 2 replacements. Typically, the run rate has been 1 replacement a year. Both of them have been for totally different reasons. In the first case, it was actually TCS going through an upgrade in our expectations of longevity and rate of compounding. And hence, in order to maintain the concentration of the portfolio, we decided to exit from Relaxo. There was nothing that changed in our understanding of Relaxo's competitive strength, which caused the churn. The second instance, as I just now mentioned, it was more about our portfolio companies' scores getting downgraded in our research framework, and hence a replacement. So different reasons. Nothing that should be read into as a rise in churn sustainably for this portfolio, which will continue to become 3 changes in a year or 4 changes in a year. But yeah, this will remain a low churn portfolio even after these changes, because these changes have happened with relatively lower allocations. The entry exit related churn in our portfolio in the last 12 months hasn't been more than 10-11%. Rest of it is rebalancing related churn. So about 15% is the churn, which is not too different from what the long-term average should be.
Thanks, Rakshit. So to some of the underperformers here, I think most frequently asked is around HDFC Life. Anything we should be concerned about, such a sustained underperformance, or rather, even in absolute terms, poor performance?
No, not really, because if you look at, let's say, fundamentals here for HDFC Life, I mean, this is the kind of top line growth that this firm has reported, and likewise for its bottom line, right? 24% 2-year CAGR is not weak by any standards. Now, having said that, share prices of different companies do go on holidays, as we've previously explained in our portfolio. So it has happened to HDFC Bank. It has happened to HDFC Life now. 3 years ago, it was happening to Dr. Lal PathLabs. During 2021, it was happening to Page Industries, and now suddenly, from where Page Industries was, it has doubled, so on and so forth. So many companies in our portfolio, not all, but many companies, they do go through periods of holiday where the share price doesn't do much, even though fundamentals keep compounding, right? So in that regard, I think HDFC Life fits in that category. When will the fundamentals and share prices catch up with each other, as in the share prices will catch up with the fundamentals? I mean, whether it be next week or next month, anybody's guess, but certainly you won't have to probably wait for too long, because in the longer term, these things certainly have to sort of correlate with each other. So no, we are not concerned about the fundamental progress of HDFC Life.
Similar concern on Nestle. Growth is clearly in your numbers slowing down. So how do we justify holding it in the portfolio? Yeah, so Nestle is actually, you see, let's say FY17 to FY22 or FY17 to FY21, the profit growth has been in the mid-20s. Revenue growth has been only around 10, 11, 12%. And the reason for this is Nestle is undergoing a
a massive rehaul of its entire product portfolio. So there are several products that are being de-emphasized in its offering. So some of you might remember 5-6 years ago, Nestle Dahi, Nestle A Plus Dahi used to be advertised a lot, used to be made available in various retail points. Milkmaid used to be made available. Maggi, tomato ketchup, etc. So variety of products, right, which used to be far more emphasized previously. Some of them have gone through a period of de-emphasis because the firm is focusing on products which do drive a bulk of the profitability, rather than having a long tail where profits aren't there but revenue contribution is there. And because of this sort of a rationalization of the product portfolio, you don't see moderation in profit after tax growth or EBITDA growth. The entire moderation is in pretty much the revenue growth part, right? So hence I think we are not too concerned here.
Fair enough. And I think there's a question in terms of relative exposure between HDFC Bank and ICICI Bank. Clearly, amongst the two big private sector banks, ICICI Bank has done on in terms of both fundamentals as well as stock price performance. How do we justify not having ICICI Bank in the portfolio?
Right. So let me actually. This is an interesting question. So our colleague Tej put together a very interesting set of data points, right? So this is loan book market share. What you see on the screen, this is loan book market share of HDFC Bank versus say ICICI Bank, right? You can see the gap. Whether you look at the last 1 year, 2 year, 3 year, 4 year, right? HDFC Bank has increased market share significantly on the loan book side, right? Which has obviously then also led to its 1 year, 3 year, 5 year loan book CAGR being way higher than say ICICI Bank's loan book CAGR, right? So there is a perception that ICICI Bank is taking market share away, but it isn't. Same is actually the case with deposits, right? This is the deposit market share of HDFC Bank versus ICICI Bank, right? Significantly different reality from the perception. So that's on hardcore numbers. Hence we are not so concerned about HDFC Bank's performance. In fact, vis-a-vis say an ICICI Bank. But having said that, yes, we do agree when it comes to investments in technology. In the last 5 years, HDFC Bank, we believe, could have done much better than what it has done. And compared to some of the competitors, such as ICICI Bank, HDFC Bank has lagged behind in tech investments, right? All those, whatever appeared in the media and all the tech glitches were only one part of it. Even in general, I think HDFC Bank could have done much better, even if its app hadn't crashed down and so on and so forth. But having said that, in the last 1.5 years, the kind of data points that we have got suggests that there is an effort being made by the new management to improve things significantly and catch up with the lost opportunities. So while fundamentals are nowhere reflecting weaknesses, capital allocation is something where we have, I mean, the position sizing of HDFC Bank has in the last couple of years undergone downgrade internally within our portfolio. So whilst we've continued to be holders in HDFC Bank, their allocation has dropped because of our realization of these few challenges. But we are actually quite comfortable more recently with the activity that's happening inside the bank here. And we are keeping our ears close to the ground. There's actually a possibility that things will improve for the better. If they do, we'll reflect it in our scores. Otherwise, ability to gain market share continues to be there in HDFC Bank in a significant way.
Fair enough. Mr. Vivek Sa has a valid follow-up to Abbott. He says, in situations like you mentioned about Abbott, are you tracking lead indicators which help take an early decision on exit? For example, if the local player was taking market share for a key product, shouldn't that have acted as an early warning sign?
Yeah, I mean, there is learning. We learn. It's not that we don't make mistakes. So in some cases, yes, we do agree. Our response times could have been a little faster, and so we learned from whatever happened to Van Heusen versus Page Industries previously. We learned from the sort of experiences of HDFC Bank on how the succession was all planned out, and we learned from several such other instances. Our response time has increased. We can't preempt these things, but yes, we can catch them faster. We are catching them faster, is what I can say. But yes, there's room for improvement, and yeah, Abbott was another such learning experience. Maybe a couple of months prior to what we did is when we could have done something. But having said that, I think it would be unfair to expect our ability to understand the weaknesses of Abbott in, say, 2020 rather than 2021 end, right? That was difficult because at that time, actually, there weren't enough number of data points that were suggestive of sustained challenges, because this can't be a knee-jerk reaction. Right, just because 1 or 2 quarters of a particular company's market share in our portfolio suggest weakness, we can't be taking knee-jerk reactions, because they can actually be massive opportunity losses in that manner. And hence we try to dig deep, collect more data. That takes a few months, but yes, from every experience, we are learning to execute that process at a faster pace.
Fair enough. Yeah, yet another laggard, Divi's. Any thoughts there?
No, I mean, fundamentals of Divi's actually are compounding at the fastest pace. So if I look at say this slide, Divi's is an outlier by a big margin, right? So the fundamentals are compounding at a very fast pace. We're quite comfortable with that. The dominance is sustained. It's investing in the right direction. The capital allocation decisions are very encouraging, and the share price, honestly speaking, over a sort of 18-month, 24-month, 36-month period, has not been disappointing at all. So just because it hasn't moved in the last maybe 3 months, 6 months, we are not concerned about that.
Fair enough. I think a lot of questions around the time horizon. A lot of people are drawing conclusions based on the share price movement in the recent months. And I think it's reiterating that short-term stock price movements, especially in times like this, should not be read much into, if at all. As long as, like Rakshit is saying, the fundamentals are strong, they actually provide you very strong buying opportunities. So we will do our best in terms of benefiting from that through the rebalancing exercise Rakshit talked about. So the last question is on IT. Rakshit, I mean, given where the rupee is headed, and if oil prices stay where they are, the rupee is likely to slide even further. Shouldn't we have a higher IT exposure, or the rupee is not even a factor in terms of our decision to position ourselves in sectors? And also a follow-up question on why not Infosys as well?
Right. Okay. So see, what we build in our expectation is a long-term growth rate of fundamentals, right? Over the long term, we do expect the rupee to depreciate, and the rate at which we expect it to depreciate is similar to what, say, the last 20 years has been, which is only about, say, 3 to 4%. It's not a 7, 8, 9% per year, right? Now, the 3 to 4% is baked into our expectations. What if we are expecting, let's say, the next 5 years to be to be X%, including the 3 to 4% rupee depreciation. So next 5 years of free cash flow compounding to be X%, including 3 to 4% of rupee depreciation. What happens if 1 out of the next 5 years sees a 7-8% rupee depreciation? Do we then increase the position sizing? I mean, no, not really. That's not how we try to position size, because these can always be short-term fluctuations, right? Long-term averages, long-term sustainability of a certain rate of compounding is what we are after, and hence the position sizing just doesn't go up and down. But having said that, yeah, TCS is in the portfolio because till a couple of years ago, we didn't see, prior to COVID in particular, we didn't see the supply side strengths of TCS being as great a driver of competitive advantages as they've become now, right? With many organizations sort of consolidating their IT vendors, because for every vertical in the organization, the applications have moved to cloud and data has moved to data lakes, etc. The need for large scale IT services vendors has shot up substantially in this sort of a regime, and that plays to TCS's strengths of hiring, training, retaining in a very cost-effective manner a very large manpower and growing it, right? That's the strength of TCS, which is actually something we are not too convinced about on Infosys, right? The attrition rates of Infosys are a lot higher than TCS. And secondly, even in the longer run, the softer aspects, the continuity in CXO layer decision making, in board level decision making that we see in TCS, we don't see that degree of continuity in some of the other Indian IT services companies, and hence TCS is the only firm that we've got in our portfolio.
Great. So that's all we have today. Thanks Rakshit, and thanks everyone for making it to the session. Appreciate it.
Thanks, Pramod. Thanks everyone.